in two extra slides here. One is something we're working on right now. We refer to it internally as the rows and columns projects. Basically what we're trying to do is three things. One is take the income statement today in rows like cost of goods sold and SG&A and basically give you a couple more lines. You know, there are obviously components within cost of goods sold like labor and materials that be helpful to understand the components there. SG&A, gosh, seems like you could divide that into at least three groups: selling, general, and administrative. And if you do that and you apply it across segments, you actually start to have a multiplier effect. Again, getting back to this, trying to provide investors with not only good quality information, but greater details, more disaggregation. The other notable thing is that segments was put in about 20 years ago, actually requiring companies to give you segment information, balance sheet and income statement. But what you do not see is the linkage between the consolidated balance sheet and income statement and the segment information. Part of this standard, depending on how the board votes, will actually help reconcile those two and reconcile the GAAP, balance sheet and income statement consolidated rules and standards with management's approach, which is allowed and actually required for the segment information, and it'll show you where is management allocating revenues and expenses or not allocating, and where they are not, and that could be very telling. So it's a project to watch. And finally, the disclosures. We wrote a framework to try to decide consistently what disclosures should be required on a standard-by-standard basis. And in doing that, we are also going back and testing it against other standards that have been outstanding, in some cases for as many as 60, 70 years. One example is inventory. Inventory accounting was written back in the 1950s, hasn't been really touched since then. I think a few things have changed. Maybe we need to rethink some of the standards there. Some people have suggested this is a let's take disclosures away because those poor investors are overloaded with disclosures. I can assure you I have never taken that view. In fact, if anything, I was in position to actually absorb a lot more information. And so far, in the areas that we've tested this framework, inventory, taxes, pensions, and I'm missing one, fair value, what has ended up happening for every disclosure we've taken away, and it's generally been a low value disclosure, we've added on average 4 new disclosures if you exclude revenue recognition. Revenue recognition is a little bit different animal because we took disclosures away under 200 different standards and added, in effect, 1. So it threw the numbers off. But excluding revenue, basically 4 new disclosures for everyone we've taken away. So it's not reducing disclosure, it's actually improving the quality and quantity of disclosures. So I'm going to leave it there and try to stay on time. If you've got any questions, we just have a website that talks about implementation issues, and it's a good place to go and find any information on any particular standard.